General Mills, one of the largest cereal manufacturers worldwide, has seen poor financial performance in 2023 so far. The company's revenue only increased by 3%, indicating a slight increase in sales, but their net income dropped by 25% year over year. With this financial performance, the stock is down by 21% year to date as well. Today we'll be taking a three-step approach to thoroughly evaluate General Mills and determine its fair value. Step 1. Margin of safety. In this step we'll look at General Mills' key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into General Mills' financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of General Mills' business. By using these models, we can determine whether the stock is currently overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of General Mills as an investment opportunity. To determine our final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. The EBIT has gone up over the years, going from $2.9 billion in 2013 to over $3 billion in 2022. The average EBIT growth during this period has been sitting at 1.2%, which is a 5% increase in the margin of safety, seeing as it falls below the 2% threshold that we have. Looking at the margin, it has stayed the same over the years, moving from 16% in 2013 to 19% in 2020, but moving back down to 16% in 2022. This is, over these years, a decrease in margin of 0.1%, which is no change in the margin of safety on this metric. The next metrics that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up nicely over the years, going from $1.32 a share in 2013 to $2.36 a share in 2023. The average dividend growth during this period has been sitting at 6% annually, which is no change in the margin of safety on this metric. Looking at the payout ratio, it's sitting at 50% currently, which once again, no change to a margin of safety on this metric. And the final ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for General Mills, this is sitting at just under 3 years, in this case, a 272% debt to EBITDA ratio, which is only a small portion below the 300% that we like. So, if you look at our scale, that's no change in the margin of safety once again. The return on invested capital for General Mills is currently sitting at 8.1%, indicating that the management is quite effective at allocating capital, but it's not above our 12% that we like just yet. So once again, no change in the margin of safety in this metric. So that means we're left with a 30% margin of safety, which is quite high. But let's go look at the valuation models next to determine the intrinsic value of the company. The first model that we'll be using is the discounted cash flow model. I've imported free cash flow of General Mills come from 2013 to 2022. The average growth rate in their annual free cash flow during this period has been sitting at almost 3.3%, and are projecting their annual free cash flow to grow by 3% over the next 10 years. With this percentage, we'll determine the future free cash flow for General Mills and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of just over $37 billion, and to get to our equity value, we have to add the cash and equivalents and subtract the debt, and that leaves us with an equity value of $26 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $44.88, which is a downside of over 30%. The second model that we'll be using is the dividend discount model. I've imported dividend payments of General Mills come from 4 years ago to the current year. The average growth rate in their dividends during this period has been sitting at 4.81%, and I'm projecting all of their future dividends to grow by 5%, and we take again the discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $70.80, which is an upside of 7%. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that General Mills is generating, growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, that is always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value of $61.04, which is a downside of almost 8%. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies, General Mills, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 17.43. All stuff to do then in this model to get our fair value is to multiply by the earnings per share that General Mills is generating, which is $4.31 a share. And then taking the average PE ratio and multiplying this by the earnings per share, we get a fair value of $75.10, which is an upside of 13.57%. And the last model that we'll be using is the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 3.22%, while the current yield is sitting at 3.6%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, on average in the past 5 years it has been sitting at 15.17, while it's currently sitting at 15.34, indicating that it's slightly overvalued on this metric. And this leaves us with a fair value of $69.66 out of this valuation, which is an upside of 5.3%. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $64.30. Margin of safety we've determined earlier, using a standard margin of safety 25% and adding 5% for the EBIT growth, leaving us with this 30% margin of safety. Applying this margin of safety, we get a fair value of $49.46, and with the current price of $66.13, this leaves us with a quite big downside of 25.21%, indicating that per our valuation it is currently a sell. If you want to get access to all of the valuation models that I use in this video and much more, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.